Hiya, it's Owen McGee here, financial planner, with your questions on Facebook Live. Get the questions in. We have a few to start off with. We've actually loads. So keep getting them in and we'll try and get through as many as we possibly can over the next little while.
Okay, so the first one comes in from Sean. So the Help to Buy scheme says that you must live in the property for 5 years. I was hoping to travel for 6 months next year. Does this mean I cannot rent it out?
That's actually a really good question. Typically, when you talk about travelling and provided you're coming back to the property and provided it doesn't turn into a long-term thing, 6 months when it's so definitive, what I would actually do there is I would be asking the question of the people inside who are approving the scheme for you. I'm actually not 100% sure. So what we're going to do is I'm going to get the answer and we'll put it up on Facebook later on, because I would imagine you're okay, but I just want to double check myself.
So this comes in from Kira. So I've come into some money to the sum of €1,000. Rather than leave it sitting in the bank, how much profit do you think I could make from investing in portfolios?
Okay, so this is a how long is a piece of string question. When we do long-term financial plans, what we would say is that if you leave the money sitting on deposit, you're going to get 1% a year off it. Now, to put that in perspective, right now, you'll probably get 0.1, 0.2%, so that's a lot less than 1%. But over a very long period of time, I think it's reasonable to assume you might get 1% per annum off it. When we look at portfolios and we start putting it in stocks and shares and bonds, we assume 4% or 4.5% when we apply our investment philosophy to it. So with our investment philosophy, we assume 4.5% per annum. To put that in perspective, if we showed our portfolios that we create for our private clients to 10 other investment houses, all of the 10 investment houses would have a different assumption on what the growth is going to be. Because the reality is, nobody knows what the growth is going to be. But we know over very long periods of time, you will get more from bonds than you will if you leave it sitting in a bank account, and you'll get more from shares than you will if you leave it sitting in bonds. So it's a how long is a piece of string question? Nobody knows the answer to. Anyone who does say they know the answer is guessing or lying. So just be careful about that, but just know the hierarchy is shares, then bonds, then deposit accounts, and realise where to put the money and what the money is going to be used for, most importantly.
Okay, so Amy comes in with a question saying, we're about 2 years off buying a house and we want to get married. How do we do both?
So you're 2 years off buying a house, but you want to get married. How do you do both? You just have to save more, I suppose. And I assume the problem here is how do I get my deposit together, and how do I get my my money for my wedding together as well? When you say you're 2 years off, I wonder, is that emotionally or financially that you're 2 years off? So if it's financially, you've obviously done some of the maths already, and it's just a case of knuckling down and hoping that you can get some more money on the table when the wedding comes and when the deposit comes. It's a lot to take on. It's going to be difficult financially for anyone, regardless of what the situation is. And we did actually look yesterday there was some research that came out that 51% of people now expect or hope or dream that their parents are going to be able to help them out financially when it comes to putting a deposit on a house. That's an awful difficult situation that society has been pushed into, and I just would take a step back, because either it's going to be a smaller house or a smaller wedding if you can't get the finances together to do both at the scale you want to do them at.
Okay, so Deirdre wants to know, is it worth switching mortgages every few years to avail of different bank benefits?
So should you switch your mortgage? Let me just talk to you about mortgages. Let me talk to you about your utility bills, like your gas and electricity. Whatever you decide in your own personal relationship life around whether you should be faithful to somebody or not, you should not be faithful to your bank, your electricity provider, or your gas provider, and all of the other utilities. You have to be promiscuous and jump around as much as you possibly can, because all of these companies, mortgages, utility bills, all of them, what they do is they say, look at us, we're really attractive, come over here, we'll reduce your costs on a month-to-month basis. And then when you start to get complacent at 12 months or 18 months in, then they jack up the prices again. So the only way you can do it is keep jumping from one provider to another. It's a pain to do it with the mortgages, it's difficult, it should be much easier, it's not, but it's worth it. And it can save you a lot of money. There are over 100,000 people in Ireland who could just pick up the phone to their own bank and get a cheaper rate on their existing mortgage. No paperwork, no nothing. That's the first thing to do. Exhaust with your own bank. You actually get the cheapest on the market already. And if you're not and you get no joy with them, shop around and see where you can go. Be careful if you're in a fixed rate. Make sure there's no penalties. Sometimes there are and sometimes there aren't for moving mortgage provider. But yeah, be promiscuous all you want when it comes to utilities and mortgages.
Okay, so this comes in from David. So my girlfriend and I recently moved in together. We were advised to add up our yearly expenses such as car insurance, monthly utility bills, etc. and take out a loan each year to that amount that our expenses add up to. That means that we'd pay them off by just one direct outgoing per month rather than ad hoc. What do you think?
Okay, so I'd wonder who gave the advice. So the advice here was that you've moved in together, you've worked out how much your total expenditure is for the whole year, and then you borrow the money and you put that into account, I assume, and you just drip out of that on a month-to-month basis as the car loan and all the expenses or the car insurance and all the expenses come out. That to me sounds like a great deal for the person giving you the loan and a bad deal for you, because you're now paying interest on that loan for the year, and if you just restructured your finances in a different way, you'd be able to cover those costs without paying interest. It's not unusual. Let's round the numbers. It's not unusual for every 1,000 euros that you borrow in those type of loans that you'll pay about 100 quid in interest. So what I would say is there are some banks out there provide these kind of budget plan accounts, and they're just a current account that have an overdraft in them, and you put the same amount into them every month, like what you're talking about doing there. You put the same amount of money into them every month, and it's already pre-approved to go into overdraft and back out of overdraft and back up and down, and sometimes you're plus and sometimes you're minus, but all your bills get met. That can be a better way of doing it than having a full loan outstanding for a full 12 months, if that's something that's really attractive to you. But let's not get away from the fact there's loads of really good technology out there now to help you to do this type of stuff, that you don't have to rely on credit or any type of paying any interest rates. One of the ones that I do like, which is difficult to get into, and I've no connection with this company, but difficult to get into, is a company called You Need a Budget. YNAB is what the branding goes. So You Need a Budget, YNAB. It's hard to get your head into it, but people who get involved with it, it's a budgeting tool. You have it on your phone, you have it on your laptop. What's great is you'll have it on your phone, your partner will have it on their phone, and you just go about your day tagging whatever you spend, and then it's all brought back to the cloud, and you can share it, and you can have lovely meals on Saturday night talking about what you spent your money on the previous week or next week. But I would say to you, a little bit of work and you'll probably be able to avoid the interest that you're paying on that. I'm not a big fan of what you've just described, and if you really need to do it, there are accounts that go up and in and out of overdraft depending on where you're at, and they're all designed to do these things.
Okay, so this comes in from Teresa Murphy. So how do I access my UK pension? I have lost my pension numbers and I've worked there for about 20 years.
Okay, so Teresa has a pension in the UK. She can't get access to the pension because she's lost the pension numbers. If you were working for a company, you just contact the HR department in the company. They will be able to track back and find out exactly where the money is and what the story is with it. If you weren't with a company, if you can even remember who the pension provider was, then I would just go to the pension provider, give them your name and date of birth, and they should be able to track you that way. And if that fails, if those two things don't work for you, the next thing you need to do is find a financial advisor in the UK. They're called IFAs, Independent Financial Advisors in the UK. There's thousands of them, and see if any of them could help you to track it down. Because what they can do, and something we would often do for clients here, is they can get what's called a letter of authority off you. And that's a signed letter from you to give them permission to go and try and find out stuff about the policies you have. And what we would do with a client there is we'd take the authority and we'd send it off to all the pension providers, and you would be shocked the amount of stuff that we find that people have forgotten about completely. People finding old SSIA accounts that they've completely forgotten about, and we'd find them from this letter of authority. So step one would be to ask the company you worked for, they've any record of it, any idea where it is. Step two, if you remember who the company was, the pension provider was, go to them directly and just give them your date of birth and they should be able to find it. Or step three is to get an independent person involved to help you find it.
She also wants to know, can she buy contributions?
Okay, so the other question was, can she buy contributions? I assume she's talking about state contributions. This is state pensions. So no different in the UK than it is here in Ireland. When you pay PRSI here, you should be entitled to an old age pension from the state when you retire. In the UK, it's the same. I've seen some brilliant figures from the UK where you write to the state pension provider and you say to them, I want to buy back some years, or I want to buy extra contributions, and they'll give you a calculation and they say if you write a cheque today for X amount, you will get an extra top up to your pension when you retire of Y amount. I've seen like the most recent one, it's off the top of my head, but the figures were roughly, they had to write a cheque for €8,000. They're going to be retiring in 4 years' time, and they were going to get an extra 1,500, I wasn't euros actually, it was £8,000. They were going to get an extra £1,500 every year for the rest of their life when they retired. Now that's a great deal if you can get it. So write to the state pension providers over there, and they will give you calculations on buying extra contributions. So yes, you can buy extra contributions.
Okay, so this comes in from Kira. So my elderly mother is lending a sibling a large amount of money to buy a house. If she dies, can me and my brother legally oblige this sibling to pay back the loan back into her estate?
Okay, so the question is, it sounds like there's 3 siblings. One of the siblings is about to get a loan of money off the mother, and their concern is the other 2 siblings are saying if the mother dies, will the other person be obliged to pay it back? That would come down to the contract, that if there even exists. I would always suggest that there's something written down, even an email between the person borrowing the money and person giving out the money. But what I would say there is if the estate is large enough, it wouldn't be unusual for the will to be adjusted to say that everybody gets a third each minus whatever was outstanding on that loan, and then that goes back to you, to the other 2 siblings. This can be worked out, but you do need legal advice on this, on how it's done, and you need to do it now, not in the unfortunate event of your mother passing away. This actually came up on air a little while ago where somebody was talking about not something dissimilar, but where someone was getting a loan of money from their parents, and would it be subject to there was a question came in afterwards, would it be subject to inheritance tax? If the money is still out, if it's a loan and it's fully repaid, it's not subject to inheritance tax. But if the loan is not repaid at the time of death and there's no ability to repay it, it is going to be subject to the usual inheritance tax rules, provided the money wasn't paid back. So you have to be careful here. You definitely need, if this is a concern now, you definitely need to get legal advice on it, because I promise you it'll pull the family apart if something unfortunate happened to your mother. So go get a solicitor to look at this for you now, to avoid the family being broken up.
Okay, so this comes from Carl. So hi Owen, I'm 7 months into saving for a mortgage. I put away €800 a month and I've never missed a savings payment as such, but 2 months ago I could only make a payment of €400 into the savings account. Will this hinder me getting a mortgage?
It won't hinder you getting a mortgage. What I would suggest is, depending on when you're saving it, if you have access to that savings account, and people who have listened to these Q&As before will know I'm not a fan of putting money in somewhere that you can get access to, savings into somewhere where you can get access to it really quickly. I love the idea of putting savings into somewhere like the credit union with no ATM card, that if you really need the money back, you have to go in on a Saturday morning and get the money out physically. But if you do have access to that money, what you might be better off considering doing is making the €800 payment that month and then going in and taking 400 out. Now, it's not ideal, but it shows a consistency of paying the €800 a month. We talk about this sometimes where people are saving and they're saving regularly, and then every July they take out some money for their holidays, and every Christmas they take out money for Christmas from their savings. That's actually okay, because what the mortgage provider looks at there when they're looking at you, they're saying, yeah, that's because they went on holidays in July and they had a great Christmas last Christmas, but they have a mortgage this year and they will actually pay us first, and they won't do these things this year if they're suffering financially or they can't afford to do it. So what I would say is ideally you just keep saving on a month-to-month basis. Don't beat yourself up over it too much. But if it's happening again, I'd prefer to see the 800 going in and then you going and taking €400 out. If you're putting in €800 every month and you're taking €400 out every month, that's pointless. But if it's just a random event, something happened, you needed the £400, that's okay. But I'd also ask you, is €800 too much? If you're saving €800 and you had to dip into it, depending on what you had to dip into it for, just make sure you're not putting yourself under too much pressure that this is just going to continuously happen, because if it's continuously happening, the mortgage provider will see right through it. If it was just a one-off event, don't beat yourself up over it.
Okay, so this comes in from Eileen. So married couple, both 44 and mortgage free. We've no pension or life insurance and we've 2 children with 1 additional needs. Can you give some advice, please?
Okay, so they've got life assurance. They've no life assurance.
There's no pension or life insurance.
So they've no pension, no life assurance, and they've got 2 kids.
No mortgage.
but they have no mortgage. So what's interesting here is generally in Ireland, when we take out a mortgage, we take out life cover. And it's often the only life cover that people have, except if they have life cover automatically through work. Now think about what we do there. We take out a mortgage, we borrow loads of money from bank, and we make sure that if we die, the bank is okay. Now, this couple don't have a mortgage, but they don't have life cover or a pension. They have 2 kids, and they mentioned that one of them has special needs. There will be a financial implication if one of them were to die. Think about it, they're in their early 40s. Let's assume they're on €50,000 each, and it's just to make the number simple for me. That means that they've €100,000 a year coming into the house, and 20 years to retirement, they're going to earn £2 million between now and retirement. And they want to know, should they be looking at life cover? Of course they should. They've got kids, and one of them has special needs. Should they be looking at pension? Absolutely. And this is where someone will sit down with you. You need to talk to a financial planner and sit down with you and look at what it is that you need to be doing. But you do need to do something, and don't just ignore it.
Great. So this is from Circa, and she wants to know, is it bad if your current account goes into a minus when saving for a mortgage? I've never missed a savings payment, but sometimes my account will dip in right before payday.
Okay, if you're dipping into it, I would look at how much. If you're constantly or consistently doing it, I'd look at how much you're putting into savings and maybe question, are you doing too much? Ideally, you don't have that. If you're constantly in, and it sounds like you're just in it just before payday, but if you're constantly in overdraft, let's think about what an overdraft is. An overdraft is there for an emergency. So if you're constantly in overdraft, it means you're constantly in an emergency. And the banks don't really like that. Now, they've got much better in recent years about it because the shift has changed. A couple of years ago, when things were really tight for the banks, what the banks were saying was, when they looked at you, they looked for reasons not to give you your mortgage. Today, they're looking for reasons to give you your mortgage. So they're a lot more lenient than they used to be. So it's not the end of the world if for a couple of days before payday you're going into minus figures, but I'd look at the overall picture here and decide, how can I adjust this and try and fix it? And it can be very impressive if you can see that it was a consistent thing, you got on top of it, and then you started to fix it, because it shows that you're managing your finances in a really, really strong way.
So the final question comes in from John. So, hi, I'm 42 and have no pension. I'm on an average wage and I'm married with 2 children. Any advice on what type of pension scheme I should look at?
So there's lots of different types of pensions. The question is what type of pension scheme should I look at? There's lots of different types, but all of them ultimately do the same thing. The type of pension that you take out is either a personal pension or an executive pension or a PRSA. To be honest with you, it's really down to your job, what you do. Are you self-employed? Are you a PAYE worker? Is your employer going to pay in for you? Are you going to have capacity to pay lots of money into it, or are you going to be limited in terms of how much you can pay into it? It's a really difficult question to answer, but just to remember, start it at any level that you possibly can. Get that tax relief into your pocket and let the thing grow tax-free. You just need to start the pension. I cannot stress that enough. Really, to answer that question, what type of pension, take one out that you can put the money into, that all of your money gets invested, that there's no upfront charges on it, that the charges on an ongoing basis are in and around 1% or 1.5% per annum, and that if you decide to move it from one employer to another, from one pension provider to another, that there's no penalties on it for moving it either. But just get started. It's really important to get started at any level. So that's really it for today. I think we're going to come back and do this again next week. We had loads of questions. We didn't get to them all. So remember when we're doing it next week to get the questions in early, and we will try and get to your question next week as well. Thank you very much.